We are live. Everybody, I hope that you can hear us loud and clear. We did give it a minute or two for everybody to get online, and we are getting to a reasonable number of attendees, so that's all good. So let's kick off. We did ask for our existing investors, probably half of the audience here tonight, to join us a little bit later. So if you are one of the existing investors and you don't want to hear the introduction to Allbest all over again, please go make yourself a cup of coffee, and we'll be here when you come back in about 15 minutes time. So on that note, thank you for joining us all. From those of you who have come from BizNews, we welcome you all. Online tonight, we've got Machiel Lucas, who I'll introduce later on in the slides, and of course our CEO from New York, Martin Freeman. First of all, unfortunately, a bit of legalese. This is exactly what we aren't. We're here to promote very specifically a product, and we would like you to make sure that before you make any investment decision, you take advice, go to your financial advisor, make sure that you understand the product correctly, and just so that you know, if you do engage with us and you are based in South Africa, we do have an FSP license. We operate under FSP license 41690. You can see at the bottom of this disclaimer. If you are coming in via the US, then we do take accredited investors, and we file in the US under Reg 506C. So once again, that is what we aren't, but let's get into telling you a little bit about what we are. So we're a global real estate company, although we only focus on real estate in specific states across the USA, and we only focus in the USA in medical real estate. So I guess the question is, why are you global? Well, it's very difficult to invest in the USA, and I think that what we have achieved over the last few years, we made it very easy for investors from all over the world to come and invest in the USA in a very tax efficient manner. So just to give you a little insight into what that is, we buy these buildings, we put them into individual entities. So we're very different from a REIT or a fund. You invest only in the building that you effectively have invested in, and your money is not handled by us. It goes into an escrow account. When the building closes, we acquire the building, and the dividends that come out of that building get split amongst the specific investors. Up till now, we have managed to assemble a rather tidy real estate under management sum of $308 million. And just to put it into context, we did sell 7 buildings in 2019. We also have over 1 million square foot of real estate that we manage across 3 states in the USA at the moment. We target, and I want to be quite specific here, we do not go after any buildings that are being developed or where there is any risk. We only look at profitable medical real estate buildings, and our targeted hour are for our investors, and I think this is super important, is between 11 and 17%. What happens is we pay this a cash on cash portion quarterly, and we will talk a little bit about that later on, but that is roughly 2% a quarter that we have managed to pay without fail to investors up to now on our medical portfolio. I mentioned that we make it super easy. Yes, you can invest as little as $5,000, and we can get into that a little bit later on. So I mentioned that we were a global company. In fact, we are listed at the moment on one of the islands. It's the Seychelles Stock Exchange. There are a number of reasons for it. We have all the same compliance as any other of the major estates are, any of the other major exchanges. The Merge Exchange in the Seychelles is part of the Federation of Exchanges, and we plan in the next 2 to 3 years to move to one of the big bourses in the US And that is why Martin is based in New York. That is where our ambitions lead. And we will do that when we reach a real estate under management portfolio of $1 billion. So I think the first question that everybody asks is, if I'm going to invest offshore, who are the people that are looking after my money? And I think it is probably the most important question that you should be asking. At this stage, our team is predominantly South African, and I think you understand why. There are a lot of South Africans that are looking to offshore their money, to offshore their businesses, so that they can live local and yet make sure that they are insulated from the local economy. So just to talk a little bit about the people on the slide here, the guy in the center, Henny Bezuidenhout, is our chairman. He has over 30 years of experience doing these medical office blocks in South Africa and has probably the biggest private portfolio of medical office blocks in the country. The interesting thing is that he went over to the States 6 odd years ago, started looking at medical over there and discovered that medical in the USA is very, very much the same as South Africa because it is predominantly a private healthcare dispensation. More about that a bit later on. I mentioned Martin. Martin has grown a number of companies in South Africa to scale. I think I can mention Martin, if you don't mind, Bayport Financial Services that I think is probably most well known for. I guess I have spent most of my life in the real estate space, but the last 20 years or so, I built an online portal called Private Property. Machiel Lucas has, in fact, done all of the real estate deals that we boast about. So he has spent a lot of time in the USA. In fact, was based in the USA on his previous job, where he was running one of the operations of Siemens internationally as an engineer by trade. And of course, Lo Viljoen, who is our CFO and comes from the public company space. So I mentioned that one of the training grounds that we have working in the public space is that we have been able to set up quite a substantial team of people that advise and let me just touch on a few of them. First of all, our board is made up of a bunch of non-executive directors. James Saperstein from the US, Darren Jacklin from Canada, Bharat Mehta is very well known in local circles, who is one of the biggest private investors in some of the big funds in South Africa, if I can mention Redefine as one of them. A lot of the guys on the right are fairly well known. There's a few internationals there, but Tini van der Mest is certainly adding an enormous amount of value to us on the risk side. We are becoming more and more involved with him, and he is ex-CEO of Sundam Investments Advisory India. So without spending too much time on that, how are we doing for time? We are 11 minutes. I've got about another 5 to give you a bit more information on who we are. So I guess the next big question is when you are giving your money over to a company, who is actually making a decision on what property is acquired on your behalf? And I think that as much as we as a team, and especially Machiel, find these magnificent buildings that we like and we bring them to market, we have to get them through this bunch of guys on your screen at the moment. And once again, chaired by Henny, our chairman, who is particularly passionate about the medical space and what trends are influencing the buildings that we buy. Somebody who has brought an enormous amount of value to our independent investment committee is David Vandrach, who is very well known in commercial real estate space in South Africa through his time at Rand Merchant Bank and Investec, where he headed up credit. He also was instrumental in founding 2 of the big REITs, RMB REIT and Ashburton. So let's talk a little bit about the investment strategy, because there is a lot of real estate available in the market. There are a lot of choices to make. And I think to talk a little bit about this, let's bring Machiel in. As I said, he spent a lot of time in the US looking at buildings and trying to do deals. Machiel, why are we in these specific states?
Yeah, that was a big question when we started in 2014. And based on the experience of our committee members, we've been driven predominantly by population growth as one of the key factors. And secondly, the fact that certain states protect your rights as a landlord much better than others. So if you look at this map, you can see we've plotted the population growth. And what we have found is that when we started off specifically in Georgia, we had basically a contact that really helped us to start. You can think of it here as a bunch of foreigners starting to buy fairly big real estate. The first transaction was about 16 million. And so we really started off in Georgia, but we pretty quickly saw that Texas has really been growing phenomenally. If you look at that 14% over there, that even one or two cities, the GDP is as big as South Africa. So it's just an unbelievable scale. And then what we are doing is we have expanded into New Jersey, just south of New York, a phenomenal growth area. I'll talk about that in detail. And then we just cannot avoid Florida. Florida has been really an absolute growth. Predominantly people are retiring down there. And so there's a huge migration from the northern states into Florida. And Florida is also a state with zero tax and similar to Texas. So it's very conducive for business. And then lately, there's been very attractive opportunities in Colorado. We've been in Denver. We've been looking at 2 deals there already. Utah and Arizona is definitely on the map to look at. And then just coming right across North Carolina and South Carolina. So you can see it's predominantly the southern states, and it's really driven by the fact that there is a huge migration specifically of the population. So yeah, in a nutshell, this is where we focus. Obviously there is other states, but you know, it's just such a large country, actually 52 countries into one country.
Yeah, interesting point there, Machiel. When you were with Siemens many, many years ago in your previous life, you actually worked in a building that ultimately we have ended up buying. And I think that is a very interesting, quirky, just a little side bit. But let's talk for a moment about this healthcare sector that we're so obsessed on. You know, I think the first thing is it's an enormous sector in the US. It's over $1 trillion. The hospitals are not the biggest portion of it, and I think I can break that down for you just now. But the medical office buildings are, in fact, where our focus is. I mentioned just now that we own 19 buildings, which we're very proud of, but there are 36,433 buildings available in the market at this stage. These are buildings that are predominantly medical, but are not hospitals. So each individual suite is operated by an independent medical practitioner or company, and they normally work in a symbiotic relationship where they service each other and refer to each other. So I think I'll bring Martin in a little bit just now, and he can talk about what has happened as a result of COVID and how people have left the hospitals to move into more of these medical office block facilities. I'm talking about the patients specifically. But this gives you a better idea. Our focus is this yellow bit, which makes up about 39% of the market. There are some very interesting opportunities that we will look at in the future, but we have to make a good enough case for the Independent Investment Committee. I think that this is one of them that we were looking at, the post-acute facilities, which is this little bit up here. So at the moment, the yellow is where we are focused. This is our sweet spot. We love these buildings because they're multi-tenanted and the tenants do not go anywhere. The other thing that's super important when you think about the US is that medical is an expense that no government has managed to influence. And the one thing that plays in our favor is that the US population is getting older. And as you can see, they exceed 80 million people over the age of 65 by 2050. So this is not only an aging population, it's an aging population that does have medical insurance and does have the ability to pay for medical insurance. And then yeah, I will get to the next slide shortly, shortly, that will give you a little bit of an insight into what else is happening at the same time. Because as we develop the technology, the medical technology that is enormously disruptive and is a subject for another day, you know, you've got to listen to Henny speaking about what's happening in the medical space. It is really exciting and really interesting. But the net effect of it is that people are getting older. So this older population are also expanding because we are developing drugs, procedures that help them to live longer. So you've got this more and more population that is over the age of 65. And interesting stat, people over the age of 65 spend roughly 6 times or 5 times actually more than people less than 65 on medical. Martin, this is your favorite slide. I think at the end of the day, we get judged on where the rubber hits the road. So let me introduce you first of all. Martin, coming to you from New York. You can't see the trees at the back of him. Maybe I'll give you a little treat just now and show you. But he's just woken up. And Mart, thanks for joining us. And yeah, tell us what you think about this.
Firstly, thank you very much for having me on tonight, and great to be here with so many people from different countries and all our South African investors and new potential investors. So Justin and Machiel have taken you through our journey of exactly what Allvest does, what we focus on, what we do, and where it all culminates is really what we do is we find great properties in the United States only, in the healthcare niche. We offer these to people around the world. We then acquire them, we manage them. And it all comes down to one thing. What we do is we offer investors around the world the opportunity to earn US-based dollar dividends on an annual basis that is paid out every single quarter. And so for 6 years, you can see the kind of returns that we have been generating. We average 8% cash on cash, and we aim to acquire buildings that will generate between an 11 to 17% total IRR. And what is an IRR? It's an internal rate of return. It's the total of all your cash dividends and other cash you receive during the project, together with your profit that you receive when we sell the building. So most people are quite surprised that you're still able to generate in excess of 10% in USD on an annual basis. You absolutely can. We absolutely do. The only differences between us and the very large players is that they obviously have very large infrastructure and overheads. They seem to take a lot of the margin. And I think that people that have gone offshore in the last couple of years have seen the dramatic kind of returns that we see on a continual basis. So that really is an assessment of how we're doing at this stage with our slide.
Great, thank you, Martin. Just to cover off, once you've made an investment, guys, I think the big thing is you're sitting very far from your investment. You might not have seen your building, although we do encourage people to go over and actually see the building that you've invested in. We have done in the past. We haven't done one this year for obvious reasons. But in the past, we have taken people over to the buildings. We do these buyers trips. But the cool thing is that we have a platform that you can make your investment online. We do have consultants that can help you to make the investment. But ultimately, you can go to this dashboard and you can see where all your money sits. You can look at your investments. You can look at all the documents that you've signed. And it is actually really nice and a little bit gamified to see your investments grow. In fact, this little slide here, if you have a look, you can see that this is a real case, and you can see the dividends growing for this particular investor as they invest a little bit into each building. So thank you very much, Martin. If you would like to tell us a little bit about what's happening in the States. I mean, we read a lot about the riots. We read a lot about how COVID is out of control. And I think maybe we watch a little bit too much CNN, but perhaps you can tell us what's really happening.
Absolutely. Justin, before we get onto that, one of the comments on the previous slide with our returns is it seems on some of the buildings that the returns are dropping. That's incorrect. What actually happens is that on some of the buildings where we do add a little bit of value, we will start off with a dividend return of about 5.8 in the first year whilst we're leasing up and putting these new tenants into the building. It immediately jumps to the 7 to 8% range. and then 8, 9, 10 onwards. And so your average still gets back to 8. So the returns certainly remain consistent. Those are the buildings we go after. In fact, if they don't meet our returns, we won't acquire the building. As far as the effects of COVID, if you can just go back to the previous, that's one slide. You know, from the middle of March, we start to really get into the guts of this terrible pandemic. And what a lot of people are going through in other countries, and in particular South Africa, that's what we went through. It's really all about flattening the curve and getting to the point where you either have got it into people that they need to be wearing masks and staying out of each other's way and social distancing. Most importantly, the aspect and the focus remains on getting the healthcare profession to the point that it can deal with these enormous volumes that start to come through. From a physical country perspective, the difference between the United States and most other countries in the world is just the enormity of their economy, of the government, and having a first world that just rallies together. And whether it's the 2.2 trillion stimulus package, whether it's the fact that every single state and entity was able to help their people within the state, it's quite remarkable. So they essentially rolled out a stimulus package that ensured that almost all rent and certainly staff salaries were covered for most people in businesses for the months of April and May. And so what that's done is it certainly softened the blow. In terms of what it would mean initially, most people were furloughed, which means they were put on short time or they were retrenched. You saw a sparking of the unemployment rate up to levels not seen since wars. And then as we moved beyond that and the cloud started to move over, so you saw everyone being re-employed again. As they opened up the phases, if you think about the restaurants, if you think about various businesses across America, each time they opened a phase, they re-employed all these millions of people that they had obviously told to stay at home and were put on short time. So the economy has bounced back in a way that many were hoping for. Yes, there will be a retightening as certain states go through these bursts of increases in the positive cases. I would also caution everyone that whilst you only have access in most countries to CNN, it is obviously hyped up. Most of the people that are going out and you see them together and in places are not the elder, more at-risk generation. It's the younger people who, whilst they may be testing positive, certainly we are not seeing an increase in the deaths. In fact, over the last couple of weeks in New York, for example, it's really dropped to very, very manageable levels. At one stage, it was 9, 10 deaths a day, certainly for a state of 20 million people. So that's really the backdrop to COVID. The big question is, whilst this is all unfolding, in Orbvest, how have we been impacted over the past 3-4 months? And so as we move over to the next slide, Justin. Over the last 3 to 4 months, what we as Orbvest have been trying to do is to ascertain how our strategy has been holding up on the tenants that were paying in March. Like all businesses, you have your challenges in all parts of the business and some parts of or aspects of a business. In Orbvest, we've been saying for 6 years, if and when a correction or recession arrives, you'll want to be in healthcare because we believe it's one of the most resilient asset classes in the real estate industry globally. And certainly it's proven to be that. Why? Because you've got tenants who are generally profitable, they're well known, they are resilient, they hang around for a hell of a long time, 10, 20, 30 years in the very same building, they just don't really move. And so off the back of that, what we've seen so far is really a 5% non-collection on some of our tenants in some of our buildings, but by and large, all of our buildings have pretty much been largely unaffected, which has been amazing. And even the ones that have been slightly impacted, for example, like general practitioners or dentists who had to close, remember they were covered from their rent perspective in April and May. And the few that did ask for an abatement, which is not a free holiday, it's just a deferral, have said to Machiel and the team that the moment they open, which is in the month of July, August onwards, they'll pay off that small amount of arrears over a very quick period of time. So we really have been very privileged that Orbvest has largely been unaffected by the coronavirus pandemic compared to many other asset classes in the world. And in fact, it's been a silver lining where we've now received tremendous uplift in inquiries from around the world of people now wanting to invest in the healthcare sector, given its resilience.
Thank you very much, Mart. I'm going to ask Machiel just to talk a little bit to this, because these slides specifically relate to the building that we're going to show you a little bit later on this evening. And I think that perhaps we need to just consider that we have a number of different selection criteria for the buildings that we look at. But ultimately, we are looking to acquire buildings for you that we can get at preferably below market value. Ultimately, the way that we make money is at the end, we like to buy the buildings, we like to add a little bit of value, let the leases escalate, and then sell them at a premium. That premium, or that capital gain that we get at the end, we share with you. I think what is very relevant is the latest data that's just come out. And Machiel, can you talk to this, please?
Yeah, so I'm just going to quickly ask the guys, simply just look at the highlight here, specifically the New York area. And then I would like to talk specifically to the next slide, please, Justin, where I think the question that I've been getting quite a lot from our investors is, how is the market holding up from a transactional perspective? So if you can just go to the next slide, yeah. So this lines that you see here are the capital or the cap rate, as we call it. And if you if you look at the cap rate, the higher it goes, the lower the price. So you can see from the end of let's say the beginning of 2019, the yellow line has been going steadily down. And you can see that the medical real estate prices has systematically increased from 2019 till the beginning of 2020. So from that perspective, you can see that it has been a very, very bullish segment in the market, and it was now very slightly affected with the uptick in the capital or the cap rate, as you can see, the 6.4. So I think the clear message that we can see in the market at the moment is that the MOB fundamentals remains exactly or very steady throughout the pandemic, and we have seen that the transaction volumes still continue during these stages. We have not seen a massive uptick, meaning there is now, let's call it, bargain buys in the market. Yes, there is some of it, but not a lot. So it's not like potential other sectors where we actually now see really fire sales prices. So what this basically means is that our sector, the medical sector, is maintaining its course throughout this pandemic. And as part of the nature of the game is that people do get sick irrespective of what happens in the market. And what happened is that essential services actually got taxed more during these times, and non-essential services, like for instance a dentist or something like that, that you can postpone, and that got impacted. So we actually have seen in certain instances that we actually had a net increase in transactions, and it just bodes well for the whole hypothesis that when you want to have a portion of your portfolio that is really steady eddy and that has proven to be resilient, this has been now again proven to be the case.
Machiel, just to ask you before we get on to the building itself, what do you look for in a building? What is the sweet spot for you? What would you put your own, or what do you put your own money into? So just give us a sweet spot.
Yeah, I think what we try to do is we try to buy a little bit more than the 6.4 cap, typically if we can above 7, so that we have a potential to get clear upside. The second thing that we look for is obviously it has to really to be in the right locations, so that we can make sure that we are part of the growth in that specific area. And then lastly, I think one of the most important things is the tenant mixes. And I'm going to allude to that in the presentation just now. So tenant mix, location, and the fact that we really would like to buy something that's off market. and try not to pay full price. So that is really what we're looking for.
Well, that was a trick question, because I think that, this building particularly ticked a lot of those boxes, and it was great to be able to find a building, I think, for you guys that look at a lot of buildings every single week and have to try and find something that works. And in a competitive environment that we were in a couple of months ago, that's really tough. And this is really just a little gem. So I think you should just carry on and just tell us a little bit about it, please, Machiel.
Yeah, so you can go to the next slide. What we found is that it was actually a transaction that has actually failed in the first month of COVID. And fortunately, Andrew, my colleague, which is based in Atlanta, have got a vast network, and he just picked up that the seller still want to continue. And so we approached him, and so from that perspective, we approached him and then tried to see if he still want to continue with the sale. Fortunately, our partners on the ground in New Jersey also knew the seller, and they managed to convince him to continue with the sale of this building, although at the lower price. And that we can see on the next slide, where we have, sorry, before we get to that, here is our partner. He is White Capital. We've done Medical 23 transaction with him. So from that perspective, very established partner, Henry and Peter. Very incidentally, they have also worked at GE Capital. I know that quite well from my previous encounters. And GE Capital actually spun off their banking division, as we call it, and that became Capital One. And we from Obvest has done numerous transactions with Capital One. So it was a very nice full circle with Henry and Alan, very experienced partners. So let's move on to the next slide after this one, please. Yeah, I think just to get back to the location, we just one slide back, please, Justin. This location is really, New Jersey is actually turning out to be such a fit for us, in the sense that it's really got an aging population that is really driving the medical need growth in the state. Hackensack and Meridian, for those that invested with us in Medical 23, we own we host one of their branches, and they are an absolutely huge group in the New Jersey, and they are really expanding the hospitals. And so it's also propelling the job growth in this area, which just bodes well for the fact that there's a great need for these type of buildings. And as a result, the vacancy has dropped quite nicely. So it really, really fits our medical hypothesis that we outlined earlier in the presentation. And if we go to the next one, Justin, then I can just...
What we should do quickly here is just bring Martin in, because Martin, you live not so far from here. In fact, you live around about here. Maybe you can just talk about the location quickly.
Absolutely. So it's about 1.5 hours from where I live around New York. And it really is a, should we say suburbia, general suburbia, affluent, a place where people like to move up into the area and bring up their families. And it's near Princeton University, or the building we're talking about. And just all around, it ticks the boxes in terms of great location, an area that continues to thrive, an area that continues to grow. It is rather affluent, and certainly is a multi-tenanted building that we believe over many, many years ahead will be sustained through the demographics.
Thanks, Mart. And this, I think you were talking to earlier on about the value that we got out of this acquisition, Machiel. So would you come in on this one?
Yeah, I think what we're seeing here is, you can see again, the purchase prices has increased. For those that can't read it so well, you can see on the yellow bar, it's roughly 464 feet, so $464 per square foot. And we acquired this building, I just think just above 246. So it's not 100% a true comparison. There is also very expensive buildings in the New York area. This whole metropole is obviously a very strong real estate area, but from our perspective, that is definitely almost below building cost, which just bodes us well for competition. And then I think I just want to allude to the entry capitalization rate, and that is the rate that we paid, and this is where the fact that we actually got it at a cheaper price than it was on the market. So if you remember on the other slides, the average cap rate for this area is roughly about 6. So it means that we have really bought it below market. So I think that's really nice. And people are asking me that, why would the guy sell this type of building? And yeah, the owners has owned this building from the start for 15 years, and they simply would like now to continue onwards. The exit cap rate is the value that we really do an educated guess on in our investments, so investors be aware of that. But we do it, as you can see, on fairly systematic data that we get from Revista. It's the largest collection of focused medical real estate transaction data in the United States. And this is really helps us with that market information. So you'll see that cap rate is driven by the number of extensions that we have on the leases. And from that perspective, it really drives the value. You can also see here that there's another building, 300B, which is a potential additional to this building that we can buy to build a portfolio. As you know, we like to buy them in tandem, and then we can group them to get a higher critical mass, which makes it very attractive for REITs to buy, and therefore we can then add value like that. There's also a senior living facility going to be built nearby, and the combination of these two buildings, tenant mixes, is actually boding quite well to supply this area. All right.
Machiel, there are some other medical buildings in the area. Would you call this sort of an on-campus type of building, or off-campus? And how does that affect the exit cap rate?
Yeah, there's quite a number of buildings in the area, and this is specifically what we call off-campus. And one of our tenants has actually is the Penn Medicine, which is a hospital system or a hospital nearby that has put its laboratorium in this specific building. So yeah, specifically here, what drives this is that it's more advantageous for doctors to have their own practices. They can charge more, but the net effect for the patients in the United States is that they actually pay less than going to the hospital. So there's a very natural drive for procedures and doctors to set up these buildings. In the vicinity, the hospitals is roughly about 10-15 miles away from here, so that it can still feed the hospital if needed, but almost all other procedures and practices are now housed in these type of MOBs. Yeah, just to have a quick look, we found that the property is extremely well maintained, and obviously we will do in the due diligence a property condition assessment report, and if there's some need for repairs, then we'll take it, but we found a very, very well maintained building. Next one, please. Yeah, I think this is coming back to your question, why I really like the tenant mix. You can see the radiology consists roughly about 35% of this floor space. They have just executed, while we got the LOI and while we signed the PSA about 2 weeks ago, they've just executed the extension of their lease till 2026. And they've got some more options, which I'll show you just now. But it's fantastic because this is a radiology group that has got 46 locations. It's a huge group, and one of the locations are here. Then you will see we've basically have got the lab facility at the bottom, which I'll speak to just now. We've got general medicine, which really is actually the entry point from a patient perspective. And as you can think, a general practitioner can then simply refer to radiology. If somebody's got something wrong with their spine, there's the Spine and Pain Institute. If somebody needs physiotherapy, that goes there. If there's some family planning needed, there's some reproductive medicine. And then mom can take the kids for the dental care. And maybe grandma or grandpa's got some asthma. So you can clearly see it's a nice mix of tenants. And so from that perspective, if we go a little bit into the next one, Justin, I just want to show quickly One of the key characteristics of these tenants, as you can see, there's options to extend. So option 1 is still 2031, 2036, and 2041. So as we are only planning to keep this project for 5 years, you can see there's an unbelievable amount of extensions that is possible on these leases. And this really creates the value. So basically means that there's a very, very high likelihood that they will renew. And if you look at most of the commencement dates, the people have been there typically almost all the time from the beginning. The building was built in 2006. So which shows us that the tenants has really been here for about 10 to 15 years. The last one is the lab that I've been talking about. This Penn Medicine is an absolute huge hospital and hospital system in the area, and that really just puts us on the map from a hospital system perspective. So it means that definitely patients are being referred to this facility.
Machiel, maybe if I can jump in here, and that's one of the things that really separates us from most other real estate companies. And our whole rationale behind healthcare is the fact that these tenants are stable, they're well known, they don't want to move. In fact, the interesting thing, which you don't often mention, Machiel, is very often when we acquire buildings, they are very concerned about their renewals because they want to pretty much stay there up until retirement. It's very difficult for them to up their practice and move somewhere else. It becomes a destination center for them and their children and their families going forward. So that really is one of the reasons why these buildings remain so stable in terms of producing their dividends.
Yeah, no, thank you, Martin. And investors, when you look at the brochure and when you sign off on the investment, please have a look at the risks. There's always risks. And what we have done in this case, you'll see the actual risk is a little red cross, and what we've done to do and mitigate the risk is really the green ticks. I think what we are taking huge advantage of at the moment is the interest rate, which we are going to hopefully secure well below 4%, and that makes a huge difference for us. And then obviously we cap that interest rate that it doesn't go up, so we really, really secure that. And at the same time, you will see the valuation. We definitely do a very low gearing, and I'll allude to that now, which really, really is one of the key outstanding features of this property is the low gearing and the debt coverage ratio. Thanks, Justin. Just allude to that 33 times or 3.3 times. It's a fantastic debt coverage ratio. It basically means that if we got the income from the building and have paid all the expenses, we can pay the debt 3.3 times the debt. So it means that I can lose some of the tenants and I can still maintain to pay the debt. As you know, that is our first rule, is capital preservation. The last thing we need is a capital call to pay the debt. So really something extraordinary must really happen here with the tenants so that we're not in that position. And normally, when you increase the LTV, loan to value, which is the 61%, if you make that if you make that higher and higher, normally then it's also more risky in the sense that the bank can then put some more stringent conditions on you. So from that perspective, I think that's just bodes extremely well. And then just talking to the purchase price, this is where we had the seller wanted 10 million, and then we got it at 9.75, and that really created the actual cap rate, which we are so happy with.
Machiel, if I can just jump in there, one of the questions we often get asked is, what is our typical gearing? So whilst most people may go 70-75% on a property, we generally believe in 65-35, meaning 65% debt, a mortgage, and we bring 35% equity. And that means at all times we are even more conservative in our approach. Here you can see a 61%.
Okay.
Great. Perhaps while you're on it there, Martin, just talk a little bit about, please, what does hurdle rate mean, and how does it actually work? What does the 60% split mean? I think normally we give 50%, so I think it's pretty cool that in this building we're actually giving away more of the upside.
Machiel, over to you.
Yeah, so Justin, I think let's go on to the next slide, which I can then allude to that hurdle rates. So here you can see the cash flow is pretty much, let's take the example 8.3. That means that it is well above the 7% hurdle rate. So the investor get basically 7 plus 1.3 is the 8.3. And obviously, over and above that, there is additional 1.3, which means that the property actually generates 9.6. And this is where we then share. I'm sorry, it's a little bit less than 9.6, is about 9.1. And this is where we share from Obvious and the partner on the upside. So what we have done specifically in this case, we have also secure interest-only loan in the beginning. So therefore, the interest or the cash on cash returns are quite high, and we've actually on purpose will keep a little bit of that income back to make reserve. The whole rationale is that we want to make sure that we can absolutely ride through the COVID situation, which we don't know if it's completely done. And then, as you see, we start releasing some of that funds in year 3, 4, and 5. So that's basically on the income side. And then on the capital gain side, you'll see the capital gain is roughly what you will see is that 15%, and that 15% is then additional to your income over and above the 9% in year 5 of income. And then for those investors that is having the benefit to have an LLC in the US, that is the return. And then the offshore investor will get the 11.25. It basically means we've taken care of all the complications of investing across from the Seychelles, and then investors on the merge platform or the Obvious platform will get all of this income in a dividend format. So investors, that's very important for most international investors, because that in most countries, I've now spoken to a lot of people in different countries, it's a flat rate, normally a dividends tax. For instance, in South Africa, it's 20%. In Germany, it's 25% flat rate. And the marginal rate, if we would have paid this in income, typically a marginal rate is 35, 45, 35 type of percentages. And that differential is really what we save you by actually doing it in this specific format. To sum up, New Jersey is really ticking all the boxes for us. We below market price acquisition, as you can see the figures over there, and then the strong leases with the multiple extensions, and then also a very simple capital structure and the low loan to value, as we alluded to. So all in all, investment that's really geared for the income side of things, specifically in this timeline. So we're very bullish about this, and hopefully you'll find it also attractive like we have done.
So Justin, while you're going to move on to the next section, I think one of the things also we just need to inform everyone is that what Obvious has really done is been able to find great properties in the USA, and we've got structures that can accommodate people from pretty much anywhere in the world. And they invest through our structures into the building in a simplistic manner. These buildings obviously are resilient, they generate the returns, and we pay those profits or dividends back to people around the world. And that's something that I think makes it so simple for people to build a portfolio in the healthcare niche. They invest slowly but surely, one after the other, into each of our buildings, and eventually they're getting this amazing dividend return in the United States.
Mark, thanks very much. We have a rule, guys, that we try not to go over an hour. We already are at 1950, so we're 50 odd minutes already. I'm going to do a quick Q&A shoot. So get ready, Mart and Machiel. This is going to be like a 30 seconds contest. Will this webinar be recorded for me to send? There are a couple of those questions. So the answer is absolutely yes. Lonnie will send it out to you tomorrow. Please shout if for some reason you don't get it. Hans, choice of building. Obvious existing buildings. Obvious ID existing buildings and buy from this current owner. Buying is deposit. Sorry, I don't understand that question. And balance with the USA mortgage. I assume
so Justin, maybe I'll just take that. The question really is around the structuring. We then obviously acquire the building. We bring the equity, the balances with a mortgage like you would get anywhere in the world.
Jürgen wants to know about Cypress Ridge.
Cyprus is not part of the portfolio. This is our medical portfolio. We have some non-core assets that we have that are historical.
What is your average gearing on the investment? I think that's one for you, Machiel.
That's 61%.
When is the closing date for this deal? I'll give that back to you, Machiel.
Closing date of this deal is 15 September, so investors have time till the end of August to bring their money.
I would like to add over there, I think that given the response on this building and given the fact that the world has opened up again and we're receiving strong demand from areas like Brazil and China and other countries, I would say to everyone that I think we're going to see a speedier closing than usual. And obviously it's on a first come, first served basis. So the total equity required is 4 million. We already, as of the first week, had 1.5 million already raised. So I believe that once we go out into our channels now, I think this is going to be taken out a lot quicker than even we expected.
Two great questions from Leon. The first thing is the problem that we've been trying to solve. And Martin, I'm going to ask you to answer how we are solving this problem in the future. Because one of the concerns is that you invest and you wait for the building to close. How are we making sure that that loop is a much tighter loop? And I think we've got another great project coming up, but you're going to have to wait for that one. But in the meantime, do you want to just talk to that, Martin?
Absolutely. So one of the things that we've done in the past is we've given ourselves adequate time to get all our channels going. And specifically, if you talk about countries where they've got to change their brochures in Brazil or China or other countries, there is a time constraint. So what happens now is that we have raised a bridging fund. The bridging fund has been used on our last 2 or 3 deals. Going forward, that bridging fund will allow us to close a lot quicker and still give our channels adequate time for them to still raise and bring their money into the deals.
Thanks, Mart. Another good one from Leon for Machiel, LLCs, but he said talks about foreign LLCs, Euro domicile. So perhaps you want to just talk to how the investment would come in via an LLC.
If you are a person that lives in Europe, you are allowed to open an LLC in the US. So a member can be a foreign person. We from South Africa have done it numerous times, and we can help you with service providers in that regard.
Another one from Hans. If you plan to sell after 5 years, what happens at the end of the 5 years if there is a recession?
Yeah, Hans, we specifically have earmarked that the timeline for the project is 5 years, but we have also been very clear that if there is market conditions that's not conducive for the sell, we have the option to extend it typically a year, or on the converse, we can actually bring it forward a year. So from that perspective, there is flexibility in the exit price, and we don't want to be boxed in that we have to do a must sell.
And just to add to that, I would like to just say that the investment committee always receives updates on our entire portfolio and always looks at the most opportune time to maximize the returns for our investors. If we can sell a little bit earlier, and as long as we can then sell it and move that money into a similar great asset, we will always look at those kind of opportunities.
Then, Tyrone, your question regarding the vacancy, we have got a 10% vacancy in there. So what happens is we allowed ourselves a year and a half to fill the vacancy, so the exit cap rate has accommodated for that. We typically will have a fully let building, but we never plan or calculate on a fully let building. We always artificially insert typically a 5 to 6 vacancy percentage in the figures from day one.
Great. Sahil from Canada, welcome. We have a lot going on in Canada now, especially over this project and the next one. $5,000 is US, I'm afraid. That would be a few more Canadians. Machiel, Russell, capital required. How much of the, you spoke to this a little bit earlier on, Martin. The capital raised on this project, perhaps I can just add a little bit of value. Let me take this myself. So as you probably know, we did pull 27 when we were already fundraising. So we had a number of investors that were already committed to that particular project. And so there is already a lump of about $1.4 million sitting in pipeline. As we have only just launched this, we have only moved about 700,000 of that, but you can say that that 1.5 is done. Martin did allude to the fund that we have raised specifically to bridge. So we will then close this as quickly as we can. We can't close before 35 days, if I'm correct, Machiel, because we have to go through the process of the due diligence, and we just certainly do a lot of work in that period. But as soon as we can after that period, we'll close. That means that you can start earning on that building, and we can move on to the next one. Ryan Black, South African tax, Machiel, do you want to just talk to that quickly?
Yeah, Ryan, when we distribute the dividends that is earned from a South African perspective from the Seychelles is taxed at a flat rate of 20%. That means that if we tell you that you will receive 9% dividend on your money per year, that's what you physically will receive. And then you obviously have to pay on that amount, typically in South Africa, a flat rate of 20%. So you simply just pay that a year or two later as you normally do your tax returns.
And there's a question here from an anonymous. The 8% yield is per annum, by the way, guys. So you earn 2% per quarter, not 8% per quarter. Leon, no, LLC is domiciled in Europe. Don't want a US one, as this is a Euro LLC allowed to invest.
I don't know the answer to that, Leon. I will get my colleague Lo Fullion to answer yourself on email.
So what I would say to Leon and other investors in the world is that we deal predominantly with people, medium to high net worths around the world, with investments from small amount right up to $1 million. And so as long as we're able to work with you and your financial advisor, we generally are able to solve a way for you to, in a compliant and regulatory approved manner, get your money into these projects and back out.
Mark Berta asks, can I invest in one building or in your overall portfolio? Martin?
So absolutely. So our preference is always diversify, diversify, diversify. Put a little bit of money into a building at a time, build yourself a little portfolio of 5 or 10 assets across the USA in different states and different buildings. Always our first prize.
For you, Machiel, Ken wants to roll out of Waterridge into this project. In other words, will the timing work?
Yes, the timing will work. If we get a positive response from the investor, the first payout will be in August. And if it's in August, obviously that will be in time for this investment.
Guys, I'm now going over time, so apologies. Let's just hit 1 or 2 questions. Tyrone, if the vacancy is filled in this building, will the cap rate go up, or have you assumed filling the space in the cap rate in the presentation?
Yeah, I've answered that already, Justin. And the next one is, what is the tax rate in the Seychelles? Tax rate for foreign earned income in the Seychelles is 0. So from that perspective,
I'm going to move on to the other question, the other list. If interest rate increases by 1%, this is France, how much will the dividend paid to the investor just decrease? I think you did answer that, but just hit it again.
Machiel, so, your interest rate on the mortgage.
So I'm assuming he's talking about if the interest rates go up in the US, how does that affect our mortgage? You did answer that. It's a fixed rate.
Yeah, no, it's fixed. So we don't take a chance on that. So it will remain at the level that we have locked it in at the day of the transaction.
What do you anticipate that interest rate will be that you lock?
We anticipate it in the region of 3.75. That is the percentage that we anticipate at the moment.
Thanks, Neil, for the kind words. You have a client in Arizona. She is allowed to invest. She can invest as long as she is an accredited investor in the US. Unfortunately, the US has a lot of legislation, and our 506C only allows accredited investors.
Via LLC, Justin?
Yeah, I think they can actually invest directly, provided they're accredited. So they can go in their own capacity if they're accredited, but not if they aren't. Just checking to see if there is any other thing that we can hit quickly. Yes, this you spoke to a little bit earlier on, Martin, but I think you need to deal with it again because their mic has picked it up. Is the average return dropping year by year? If you look at the cap table, and I won't pull it up, it'll take too long, but the number does seem to go down. And there's, I don't know who's better to answer this. Maybe Machiel.
So Justin, I'd like to take this.
Okay,
so this is one of my favorite questions. Absolutely not. So the only difference is that in some of our very big buildings, for example, 25 or 26, when you already have approved leases on the day that we sign and take over the building, the returns may start at around 6. And then as the new tenants come in, it moves to 7, 8, 9, or 10. Your average on the project will always be more than 8. If it's not, we won't buy it. If it's not safe and secure, we won't buy it. The only difference is that in the very first year when we acquire it, for example, Medical 26, we already had the leases in place, but for that first, call it 12 months, it will generate, for example, a 5.8.
Thanks, Mart. We're going to just hit one more question. Otherwise, we really are eating into your I believe if you're in South Africa, then you're going to listen to the president speaking, and he is probably coming online now if he's not too late. So last question, and I think this is also an interesting one. The overall US population, according to Mike, is decreasing. How come the states that we invest in, the population is growing? Is that true, I guess, is the question.
Yeah, Mike, we have our requirement for population growth is actually much stricter than a simple year. We are taking for the specific area, like let's say Dallas area, Atlanta area, and we then have that an average growth over 5 years, and that's what we've seen from a population growth. So it's specific to certain areas, and therefore not specific to the overall US side. Of course, there is states that is shrinking. So we have picked specifically the ones that's growing, and we're not looking at a one-year wonder. We are looking at a consistent growth, because that's really what it's all about, so that we expect that consistent growth to continue for the next 5 years, because that's really when it matters for us. So yeah, so those figures are trend figures, not individual figures.
Guys, absolutely. Thank you very much, Machiel. Martin, thanks for waking up early to talk to us. For the rest of you, really appreciate you joining us online. Please message us if you'd like to get in touch with a consultant or go online. We have a chat bot on the website that you can ask any specific questions as you get through, or just drop us your name and we'll get back to you in the morning. But thanks again and good night.